Good afternoon. Thanks for joining us today. We have a presentation with Akiba Leisman, CEO of Mako Mining. I'm sure most of you are familiar with Mako. Trades on the TSX-V under the ticker MKO. For those of you that might not be familiar, there's lots of videos on our YouTube channel to get you up to date. This is mostly just going to be a company update and a Q&A. As always, will contain forward-looking statements. You can find out more about those on the company's presentation on their website. And like I said, it's going to be Q&A, so feel free to input your questions in the Q&A box and we'll have those addressed. And with that out of the way, Akiba, thanks for joining us again.
All right, thanks, Deb.
Yeah, maybe you want to run us through a bit of an update and then we can get to some questions.
Sure. Probably the biggest thing from the operational side was that starting in late March, we had some metallurgical challenges when we were transitioning from the oxide part of the deposit to the transitional and eventually the fresh material, which is contained in a carbonaceous ore body. Let me see if I can actually get it up on the screen to kind of show everybody where we are. Now, I don't think you need to be a geologist to see this. The brown mocha stuff, that's oxide, looks pretty good. And then you can see where it gets to that dark black stuff. That's our host rock in carbonaceous schist. Now, the issue with carbon is that that's the primary way you wind up recovering gold. That's why they call it a carbon in leach or a carbon in pulp. And obviously we knew about that. It's pretty easy to see, obviously, in the deposit now that it's opened up. And then when we were actually drilling this through our core, you could very clearly see the transition zone. It's actually the reason why we developed our plant as a carbon in leach. The primary difference being that we don't introduce cyanide into the mill. And then the first time that we actually introduce cyanide is when you have these the slurry in our leach tanks that are there with activated carbon that acts as a much stronger recoverer of gold than you would see in the native carbon in our ore body. Now, the net effect of that for a whole host of reasons, and I'll go over each of them in a bit, meant that our expected recoveries should have been going down from about 93 to 86% when we went from the oxide material down to the sulfides, the fresh material. And when we were in oxides for the first year of operation, we were averaging about 92.7% versus that 93, which is about as close as you can get from a real life data perspective. And then we reported our Q2 numbers, which had the three full months of having this diminution of recovery. Our average recovery was 74.5%, right? So there was, let's call it anywhere from 1,000 to an 1,100 basis point differential between what we were experiencing over at the mine versus what we were getting over at the plant. Now, there was a few primary reasons why that was occurring. So let's say if you take this 1,100 basis point difference, about 80% of that 1,100 basis point were associated with two things, and then there was about 50 different reasons that dealt with the remaining items. But we'll deal with the first two. The first one is that our entire plant over here is using recycled water. It's a zero discharge facility. I'll show you a little bit about what we do with our tailings. This is a dry stack tailings storage facility. After our tailings are filtered and pressed, you could see our filter press over there. It takes out all the water, and then we take that water and put it back into the plant. Now, we designed our system that recycled water should be killing all of the activated cyanide, the free cyanide, before it went back into the mill. And for a whole host of reasons, we were not able to do that very effectively in March and April, May, and to a certain extent in June through the detoxification system that we had over at the plant. So we had to make a fairly sizable change to our flow sheet where we changed our what's called an Inco air SO2 process to detoxing our cyanide with the use of common bleach, sodium hypochlorite. solution that basically takes the free cyanide and turns it into a cyanate before the recycled water goes to the plant. Now, I'm happy to say that really since the July, we've been getting our cyanide levels down to effectively zero. It's been taking it down from we were experiencing maybe 15 or 20 ppm of cyanide really in the latter part of Q2, and now it's down to about 2, which really you don't have any major effects. So our detox system is working. Our CIL is actually working as a CIL versus a CIP. I mean, the main difference between a CIL and a CIP is you kind of cycle through all your cyanide in the slurries of your mill before it actually gets to those carbon and leach tanks that you see over to the left, and that has been resolved. And that was actually a very, very big difference in terms of our experience with the recoveries. Now, the second bit is really more lithological in nature. So the way that we mine the ore body is through a very, very selective process, where you can see those faces over here. Those are 6-meter benches, but we don't mine on 6 meters. You can see on that phase 2 pit that we have on the top part of the right, there's a 3-meter bench over there. We also don't mine on 3-meter half benches. What we do is that we take channel samples every 4 meters on long section, and then we take a sample of the grade that goes to our assay lab. And then prior to July, we were basically making a decision. If the grade is good, let's send it to the mill. If the grade is not good, let's send it to various stockpiles, whether it be waste or low grade in nature. That's not good enough, right? So if you have material that is grading good, well above cutoff, but it contains material that is potentially carbonaceous and what's called preg robbing in nature, you better be very, very careful before you put that to the mill. So we had to develop some pretty robust sampling mechanisms over here, where we were not only taking grade profiles, but we were taking qualitative samples on whether or not the material was going to be high or low preg robbing in nature. So we were not just doing grade control, we were doing lithological control on how we were taking that material and moving it over to our plants and processing it in batches. Now, that was not like turning on a switch, right? So we had to develop the testing protocols. We had to develop our laboratory procedures in order to be doing these cyanide spike tests to measure preg robbing the nature of our material. And then we had to do a lot of training with our grade control geologists as well as our plant operators to make sure that the stockpiles that you see in the back right over there are processed with very tailored recipes of batches going into the mill to make sure that we maximize the amount of recovery that's coming out based on the type of material that's going through these mills. It is very fortunate that we had the ability to mine this mine as selectively as we did, because more or less seamlessly we were able to implement all of these processes and procedures and get the right batch recipes going into that crusher and eventually the mill, such that right now our experience with recoveries is now it's back up to about 85%, almost exactly where we would expect to be from a metallurgical point of view. So I have to say, like, even though this was expected, I mean, you can see it in the ore body. It's like when this goes from your lovely tan color mochaccino type ore body over there to that very dark black, you can see it obviously. So we knew about this happening, but there was a confluence of events that caused us to have that diminution of recovery. So we implemented all of these processes and procedures on August 7th. It takes maybe about 48 hours of residence time over at our plant before you see any clear recovery change. And then really starting August 10th, our recoveries are back in line. That is a huge deal for this company. This was a major operational challenge that we needed to overcome. It speaks to the talent level that we have over at site. It obviously speaks to our processes and protocols. It speaks to our ability to change things kind of on a dime. But we were very fortunate that we were able to get back to recoveries, because it was a big challenge. I mean, practically speaking, when you're talking about 1,000 basis point diminution of recovery, on the back of a operation that should be producing, let's call it 10,000 ounces a quarter, you lose 1,000 basis points, you lose about 1,000 ounces. You lose about 1,000 ounces at these gold prices, you lose around $1.2 million of your expected cash flow coming out of the mine. So we did that in Q2. We experienced that a little bit in March, and then also really up until the very first week of August. So these were our Q2 numbers, including the diminution of recovery. So this was the 74.5% number. We were generating $7.5 million for the quarter of pre-tax mine operating cash flow. You can see exactly where the cash was going. We made a $1.7 million net debt repayment. We have now ramped up exploration to about $1.3 million per month. So last quarter was about $900,000 a month. You see that $2.7 million over there. Now it's approaching close to $4 million for the quarter. So you can see if we were not able to get those recoveries back in line, there's a little bit of a misbalance in terms of what was happening with the cash. Now, while all this was going on, the last time I publicly guided the market in terms of where we were going to be with respect to debt balance on our balance sheet, right? So this was back in March, before we had the obvious metallurgical issues associated with the plant. For everybody who's unfamiliar with Mako, just to kind of rehash where we started and how we funded our three-stage objectives. So everybody remember, we got this up and running at a 500 ton per day facility, the highest grade open pit mine in the world. It's essentially designed as a pilot plant, but the pilot plant in and of itself has been generating about $40 million over the course of the last 15 months in pre-tax operating cash flow. And really, since the mine turned on from a commercial perspective, in its first 12 months of operating cash flow, it generated about $32 million for those 12 months. So even at a pilot plant level, this is an extremely profitable mine that was able to fund really our second and third objectives, really getting all the groundwork to make sure that we had enough resource at a discovery that we made a couple of kilometers to the south over at Las Conchitas. Being able to delineate a resource, being able to permit the mining of Las Conchitas, and to be doubling our production from 500 to 1,000 tons a day. And then thirdly, to go and fund what is now a $17.2 million exploration program that is now fully ramped up to about $1.3 million a month in order to crack the code of this orogenic gold mining camp. We have 28 kilometers of strike under our belt. There is gold that goes off our property in all directions, and everything that we see about our operations, our geology over at our site is really confirming everything that we thought about this property from the beginning, is that this does have the potential to house millions and millions of ounces of gold when all is said and done. Going back to my original point, when I made that statement out in March, the expectations was that this company was going to fully repay the principal balance that was due to the controlling shareholder by the end of this quarter. And I'm looking at my watch right now, and the end of this quarter is actually on Friday. So just so everybody has a refresher of how this was capitalized, we made the decision to start that 500 ton per day operation by doing a $20 million equity raise in 2019. That was through a rights offering that was issued to all shareholders. And then in February of 2020, about 4 weeks before the pandemic began, we took a $15.15 million loan from the controlling shareholder that wasn't designed to complete the full capital needs of the company, but it was really designed to get us just at the level of first gold pour that we were expecting initially sometime at the very end of 2020. 4 weeks later, the global pandemic hit. We lost access to the country for about 4 months. We had to have our local contractors kind of hold fort and make sure that the construction was able to continue apace, even without our key operating guys over in the country. And then we were hit by 2 major hurricanes at the end of 2020. So all of that led to maybe in aggregate about a 3 or 4 month delay to the project. And then in order to finish off everything, we raised a second tranche of US $20 million that was there to really get us to commercial production. So not only first gold pour, but to really capitalize everything that we needed to capitalize in order to fully finance our business plan through the operation of the 500 ton per day pilot plant, and then being able to use the $32 million a year at these gold prices, operating cash flow, pre-tax operating cash flow that came from the mine in order to fund the second and third objectives. Now, on top of that, even beyond funding the exploration work over Las Conchitas, the surface acquisitions associated with that, the $17 million exploration program, we still had enough capital coming from the mine to repay an aggregate of US $12 million of debt, both through that $15 million loan that came through Wexford, and then through another working capital facility that we took earlier. So that $12 million caused that $15.15 million loan due to Wexford to get repaid to that $6.9 million that you see over here. So even though we were able to repay $12 million of debt through the operating cash flow of the mine, my expectation was that that number should have been closer to 19 if everything kind of worked according to plan. So obviously 5 months of having 1,000 basis points of diminution of recovery. Obviously the gold price is not as high as it was before, is the reason why you see that as a $6.9 million number and not a zero, like I said that it would be back in March of this year. Now, that being said, the primary objective of this company is to make sure that we finish our business plan, which was to start this pilot plant, to make sure that the cash flow is going to be used to expand our operations through the delivery of resources over to the south from Las Conchitas in order to justify making the expansion of the plant. It's probably going to take a fixed infrastructure CapEx investment of about $4 million to do that. We are permitted to do that over at the plant. It's also going to require a little bit of surface acquisitions over Las Conchitas, and obviously a lot of drilling over the course of the next years, but we're going to have the initial resource and the initial Las Conchitas up and running probably sometime in the middle part of next year, dovetailing with our decision to go and expand our operations to 1,000 tons a day, and then obviously start drilling elsewhere on the property to make sure that we can really prove that this is an orogenic gold mining camp that does have the potential to house millions and millions of ounces of gold. But we have to do that from a position of strength. We have to do that from a position where our balance sheet is not as tight as it is right now. So I've guided the market over the course of the last couple months that we're going to have to do things that gives us a little bit of breathing room associated with it. So nobody should be surprised if something happens. And then likewise, it's not even just about the internal operations and kind of our three-stage business plan over here. We are bear market investors. It's myself, the controlling shareholder over at Wexford. When we see declining commodity prices, when we see stocks that are eviscerated, it's not like we run away scared. It is in our DNA. It's in Chuck's DNA, my former boss over at Wexford. He's an extremely skilled investor. I would say probably the biggest attributes that he has in bear markets is one of being able to see opportunities. And frankly, when the bear market started to happen, this was not a time for us to kind of shy away from that. In fact, the genesis of Mako really happened at the depths of the bear market back in 2014, where the foundational transaction that put the company on the path to becoming what it is right now occurred, principally because there was no other capital available for the predecessor company at the time. And likewise, we're seeing similar opportunities come across our desk right now. And we can't approach that with a weak balance sheet. We can't approach that with fear. So we're actually looking at this market drawdown that's turned into a pretty severe bear market over the course of the last few months as a way to really take advantage of a situation where everybody's kind of in hibernation mode, trying to figure out what to do with their own organizations. This is the time for us to really take Mako to the next level and really turn it into what we think will be a successful mid-tier mining company, something that we've said we're going to be doing from the start, but this is the time to execute it on. So with that, I'll open it up to any questions, and we can go over anything you want operationally, kind of where we are, stock wise, balance sheet. I leave it to you.
Well, I'm glad someone's enjoying these bear markets, Akiba. So I think most people are pretty despondent, but I agree with you. It's a good time to be in company building mode. So a couple questions from the audience. And let's start with this one. With this black carbonaceous pre-growing material not mapped or identified during the initial metallurgical studies that showed 86% recoveries, how come this was a surprise? If you only use this mined carbonaceous ore 100% with no blending and process it through the plant, what approximate recovery range should we expect? And sorry, that's a bit of a run on. It's the last question in the Q&A box, Akiba, if you want to actually read it in front of you.
Yeah, I got that. I didn't think I got the actual gist of the question. So first of all, this was not missed per se, right? So you could actually see the difference. This is something that was quite obvious in the core, where you see that the transition from the oxide to the carbonaceous material. When we were doing our 2014 met work with the former company Golden Rain. So remember, I took over as management at the end of 2019, but have been involved with the predecessor company as an investor and a director, really going back since 2014. The predecessor company put out a preliminary economic assessment in 2015. And that was based on a reasonable amount of metallurgical work that was done as part of that PEA. I won't get into some of the deficiencies on the resource side, but basically some of the data that showed up from that. You would have these composite samples that were going through metallurgically. On the oxide, you'd see 95, 96, 92% recovery. Everything looked fine and clean. You would go through your mineralogical report, and you basically see that there's very, very little encapsulation of the sulfides, the gold encapsulation within the sulfides. So usually you're going to have your minerals, the gold associated with minerals being in free gold or an electrum. The amount of encapsulation within sulfides is in the single-digit percent, which is actually why you should see a diminution or recovery from the 93 to 86%. And then you would do these samples back in the 2015 PEA work that was done from 2013 metallurgical samples in the sulfides. You'd see 92% recovery, 83% recovery, 85% recovery, 7% recovery, 83% recovery. Well, did you say 7% recovery over there? What that was done on that composite sample was it was run through a carbon in pulp bench scale test, where you were taking this material, you were mixing it together, the slurry with a cyanide, and there was clear response to preg robbing on that. And then the first thing that we did when we first got involved with the company back in 2014 is that this metallurgy has to be redone from scratch. There's like too many question marks about this material. You can see the black nature of this ore body. So we actually did very robust metallurgical testing in 2018 and 2019 that basically said you cannot run this thing as a CIP, right? So this has to be as a CIL. You need to optimize it to make sure as much gold is being recovered as gravity as possible. And then when you're in the CIL, make sure that everything is optimized with respect to cyanide concentrations, carbon concentrations, make sure that your carbon is clean, to make sure that you give yourself every bit of opportunity to get yourself to the 86% that is required. So for a period of about 4 weeks, we designed our system with that in mind. We were doing an industry standard process called the Inco Air SO2. So it was a sodium metabisulfate detox element with copper sulfate associated with it. You put in oxygen that allows you to turn your cyanide into cyanate. Dozens and dozens of mines do that. For whatever reason, we were not able to get our cyanide to levels that we needed to do, and then we asked the government to amend our processing to do a little bit more of a foolproof detox program to get this thing into detox mode with our sodium hypochlorite detox, and that's been working, right? So we're basically putting a lot of bleach, a lot of Clorox into the system to make sure that we kill the cyanide. So we knew about it 4 or 5 weeks, where I actually still don't have a great answer as to why the Inco SO2 wasn't working. But at this point, we now have the detox. The more important one, and this is kind of going to the gist of your question and kind of looking back in history, the ore body is kind of interesting in that the vein, this 1.25 meter wide high grade vein that's averaging 17 to 20 grams a ton, is fine. I mean, you can see some stylitic textures that has carbon running through it, but it recovers fine. You run it through your test work, covers 90+%. The hanging wall and footwall is different. So that is material that's on either side of the vein that could be grading high grades. I've seen individual assays in the footwall that have been grading 10-ounce material. So you can be, it's generally inconsistent in terms of those grades. The average grade of the hanging wall and footwall is only about 2 or 3 grams, but you can have some very spiky grades associated with that. The hanging wall and footwall, though, sometimes it's fine and sometimes it ain't fine. So the protocol that we have, the ability to kind of mine this selectively and make sure that we have as little of the preg robbing hanging wall and footwall going through the system. We take samples throughout. So sometimes the hanging wall and footwall is perfectly fine and not preg robbing. And we mix that with oxide material from the rest of the plant. Why this might have been missed or at least non-optimized in the metallurgical testing is that a lot of the composites were coming from our core samples. So we were probably developing composites that were really there to get a grade profile. So low grade, medium grade, high grade, rather than a lithological profile on what this would look like from operations, meaning take the vein, take 20, 30 centimeters of hanging wall and footwall, which is potentially preg robbing, mix it all together, and then go do the test work. So I think in retrospect, there may have been some biases in the data over there that is kind of being proven by the fact that now that we actually have the selective mining approach, it's actually mimicking what the metallurgical testing was looking like in 2018, which lo and behold, surprise, surprise, we have the same exact metallurgical recoveries as was being estimated from the 2018 to 2019. So it wasn't like this was a complete and utter surprise. There certainly were some operational difficulties that we needed to get over, and it's fortunate that we were able to do that. And it's great that we have a team that can actually operate and make adjustments like this in real time while the mine is going on. But I would say in retrospect, there was probably some differences in how that network was being sampled versus how we were mining this and processing this really really from July of this year, from inception. I mean, it just didn't have any effect when we were in the oxide zone. So your point is well taken, but that's probably why you would see some of that level of diminution.
Okay, thanks for that explanation. It was really thorough. So what is your current strip ratio and what do you expect to be the long-term average?
We mine in phases to try to keep everything more or less stable. So what you would consider to be our phase 1 stripping is that smallish deep pit that you see in the center of your screen. What you see over in phase 2 is that pit that you see just on the other side of the that black pit area. And then you have everything to the right, which is kind of our phase 3, which at this point is, I would say, almost 100% waste over there. So for Q2, you can see our Q2 numbers on what the difference between phase 1 and everything was, right? So we were doing about a 7-to-1 strip ratio on phase 1. So that was that small like internal pit over there, and then the total strip ratio is about 26.5-to-1. So that was probably, I don't know, call it a 30-to-1 number on phase 2, and then a 1,000,000,000-to-1 number on phase 3, because it was essentially all waste, and everything averaging together was about 26.5. From inception, the life of mine strip ratio for what we saw in the open pit over here was going to be running at about 23 or 24-to-1. The first year of operation wound up being around 17-to-1, so it was a little bit less than before, but we try to keep the strip ratio kind of level in terms of what it is right here in the mid-20s. Now, from an economic perspective, remember that like our overall all-in mining costs, everything with diesel, the movement, haulage distance, and everything is running just over $3 a ton over here. So $3 a ton, if you're going to be moving 27.5 tons of material to get things, a ton of ore delivered to your mill, you figure that's going to be running you somewhere in the neighborhood of what is that? Let's say $75-$80 a ton, thereabouts, for a ton of ore, and our grades that for the diluted vein material you can see over here for Q2 was 13-to-1. So a little over a third of an ounce, but really since inception, this has been a half ounce. So on a per ounce mining costs for the diluted vein material, at least, it's still a couple $100 an ounce at these kind of strip ratios. It plays with people's heads a little bit. It's like, whoa, you got a high strip ratio, but really this is not what drives the economics of our deposit. Like obviously with all the challenges that we had from the processing point of view, it's the processing costs that kind of actually have the biggest impact kind of on our all-in sustaining costs and what we have to do to manage what is a particularly complicated ore body.
And talking about your processing, when do you plan to make a public decision about expanding the mill to 1,000 tons per day?
Yeah, so the mill is already permitted to go to 1,000 tons a day. So really, what you need is not only enough ore to run it through consistently. all those white packages over here, we're probably like the largest purchaser of Clorox, or the generic Clorox in the country of Nicaragua, because of our DTAX program. So all of that is sodium hypochlorite. It smells like a swimming pool if you go down to our mine. But you can see we have those 5 columns over there. The foundation's already poured for our 5 tanks. We have our 2 mills. Probably can't get a great, let me see if I can actually show you Betty and Bertha over here. We have 2 500-ton per day mills that are run independently right now, but they can be run in concert. It looks like Bertha on the right is the one turning right now. So you have those 2 there. You have our crusher, which can easily handle 1,500 tons per day. Our filter press is run actually really, really well. When we first started this up in Q1, Q2, we were having some issues with getting that stabilized. Now it's running like a champ. I would say we'd be able to push that filter press to about 750 tons a day. So we probably have to add a little bit of capacity on that side. Everything that you see with respect to the plant, and this is going to be an important point when it comes to balance sheet, but everything that you see with the plant over there, it's going to take less than $4 million to get this to 1,000 tons a day. It's not really a CapEx decision. And then the payback on that kind of capital is, we do expect when we're bringing in Las Conchitas, I don't really see anything materially different in terms of what grade thickness profiles look like. So I think obviously thumb in the air a little bit at this point. I do think the diluted grade coming out of Las Conchitas is going to be similar to what we have over at San Albino. So if you do 1,000 tons a day versus 500 tons per day, it effectively will be doubling production. That gold ounce production, that incremental 500 tons per day, based on kind of the attributable overhead that we have to the second 500 versus the first 500, will be about 25% cheaper than what we're doing on the first 500. So huge economies of scale in terms of getting this up and running. So it's not like we're waiting to have the capital to go and make the expansion plan. If we had the ore, we would have already made the decision. So really everything on that front is associated with when are we comfortable having enough feed coming from Las Conchitas. And really that's a little dance that's going on right now. So we've broken up our property kind of in various degrees of advancement in terms of where we are on the resource side. I'd say Las Conchitas South, we'd be able to put a resource on it today if we wanted to. We made a material discovery over at Las Conchitas North and another one over at Las Conchitas Central that we're advancing. There are right now 5 rigs of our 7 that are focused over at Las Conchitas. We'll be able to have an internal resource on that, I would say, over the course of the next 2 months, kind of leading up to our ability to publish a public resource probably at the end of Q1 of next year. But at least from an internal comfort perspective, we should be in that position sometime very late this year. Now we also need to get this permitted, and this becomes a little bit of this is where the capital dance comes into play. So we obviously have all of the surface rights around San Albino. We have all of the surface rights associated with the prospective area of ground over at Las Conchitas. And then there are further parcels that were not there to limit our exploration program, but could potentially be there to limit expansion, infrastructure, nuisance, right? We live in a community over here. You don't really want to be designing a pit that's going up to somebody's house. So you do want to make sure that you kind of take care of that before you submit your permit. So the last thing you want to do is to go and permit something that has the expectation that you're going to need to do something later on. I would say over the course of the next couple months, when we're getting ready to submit our permit application for Las Conchitas, we'll probably need to make another, let's call it $1.5 million type number surface acquisition before we have everything that we kind of need. That we're basically saying that this is going to be a no-brainer to get permitted. Now, those are the types of decisions that, frankly, if we were flush with cash, we had a tremendous balance sheet going in from last year, it would have already been purchased at this point. Those are not kind of risk items that you want to leave on your plate. But because we were doing a dance with our balance sheet over there, these are things that were kind of like leading us up to this decision over here. Is like, guys, we're out of time. Like before we submit this permit, we better clear this up. So it's one of those things where I've been communicating to the market over here that there are ramifications, not only just in terms of outward facing, in terms of other potential opportunities, but even internal. There are decisions that are being made. They're not necessarily the best ones, simply because our balance sheet is so tight. And like at that point in time, you're going to have to basically kind of make sure that you have the ability to move forward on your business plan and do things that make the most sense for the business. We're fortunate that we have a controlling shareholder that's there. They've obviously been super supportive in the past, both on the debt and equity side of things. They pushed back the maturity of the debt, so it's no longer a current instrument, at least on the principal on the balance sheet. And there should be expectations that they'll be supportive in the future as well, until Mako becomes a much stronger company.
Okay, and there's a lot of questions on the balance sheet, but I have one last question on regional exploration. Since you have that slide up, I'll address that, which is, how is the regional exploration progressing towards proving the presence of a major orogenic gold camp with the potential for a multi-decade mine life? I mean, you've kind of covered it a bit, but maybe if you could do a more thorough. overview?
Yeah, so
How you're progressing things?
so right now there's not been a single drill hole that's been put out outside of the pink and orange area that you see on the screen. We've put in a few holes for the first time over at Puerto Rios, but on this side of the river. So I view everything that's kind of tucked away between Rio Jicaro and Rio Suzukian in that area kind of as our like next 10 years of open pit and even potentially underground mining over there. That's kind of like near term stuff. And then there's other stuff that can actually jump the queue very easily. Like I think I mentioned this publicly before. Over at Las Conchitas, you walk the ground, you could see that's going to be a mine. If we wanted to get that up and running over the course of the next 3 years, we could. But this goes back to almost the balance sheet dance. So right now, everything that we've done outside of the confines of those two rivers have been on the prospecting side. They've been on the sampling side. They've been on the communications with the artisanal miners to see access to underground working, so we can have some sort of geological interpretation side of things over there. There's never been a drill hole that's been put onto this, and this is kind of how we approach the world. We have 7 rigs that's on site. Right now, our most valuable commodity is time, right? We need to get this thing permitted. We need to get our resource out. We need to start mining Las Conchitas and everything associated with it. So all 7 of those rigs are focused on 2 of them over the Southwest Pit. We'll put out some additional spectacular results coming from the Southwest Pit over the course of the next few weeks, and 5 of them associated with Las Conchitas, 2, and 1, north, central, and south, which is the most advanced part of our resource. Really all there to make sure that we have enough resource to make the decision to go to 1,000 tons a day. If this company was being run for promotional purposes, which not necessarily a bad thing, just like kind of different in terms of the way that we run the world, I would take 1 or 2 of those rigs right now and move it to La Segovia, and I can guarantee you that we are going to be making a material discovery over there with some of the splashiest grades you've ever seen coming from this project. We do not run the business that way. We run the business in terms of what our constraints are with respect to our balance sheet, with respect to our team, with respect to our negotiations with the government and the community. We are not running this company based on where we think the next press release should be. As much as we like to put out our press release with nice cartoons and do the arm waving on Twitter, we're excellent at that as well. But in terms of brass tacks in how we manage this business, we're managing this business to make sure that our 3-stage plan gets going and prudently, and make sure that all of the decisions are being made with that in mind. But in terms of your question about whether this is going to be an orogenic system, it is. We've proven it. I think the week after next, we're going to be over at the Geological Society of America, putting our stamp on it with the help of the Colorado School of Mines. There's no question in our mind that this is an orogenic district, that we are only starting to scratch the surface of what this can wind up being. And frankly, even within this 28 kilometers of strike that we have under our belt, which is mineralized everywhere, gold goes off our property in all directions.
Okay. And then talking a little bit about your exploration plans for next year, the year after, et cetera. Do you see the annual exploration cost at 17 million, or does that number decrease over time? Maybe you can give us a little bit of guidance on what to expect going forward.
We are not target limited, right? So everything that we have is worthy of drilling in terms of where we are, right? And that's both the 7 rigs that are at Southwest Pit and Las Conchitas. That would be the case over at Puerto Rios. That would be the case over at El Calfa. That would be the case over at La Segovia, where it was one of our large non-Wexford large shareholders pointed this out, because there's some good and bad things about our geology, but it kind of plays with people's minds a little bit. This is some of the least risky type drilling that you can do, because we can sample there's actually very little outcrop, but generally the veins come within 1 or 2 meters from surface. So we have very good indications that the ore body exists with a geochem program. We have sporadic artisanal mining around our properties, and that's good in both fronts. It's good that there aren't that many, otherwise we'd have to displace a lot of entrenched people over here, which is always a socially difficult thing to do. So really, most of the artisanal miners that we have are very friendly and they're very supportive, and there just aren't that many of them. So that's actually a good thing across the board. We have very, very good working relations with them, and likewise, when it's safe to do this, we trade ideas, right? So they allow us to come into their underground workings, sometimes even open pit workings for that matter, see how the ore body lies. We get wonderful insights in terms of what's going on geologically across our property. So it's very low risk type exploration. That's why I can say, like, if we had a couple rigs over at Las Conchitas, we're going to be making a discovery over there with super splashy grades that come with it as soon as we're ready to do this. The downside of our geology, though, is the geometry and kind of how the ore body behaves, is that there's never going to be a single hole. I shouldn't say never, but I haven't seen any information that indicates that there's going to be a single hole that basically allows one of our geologists to say, "Eureka! We found 2 million ounces," and everybody's going to be over here high-fiving each other for the discovery of the century. This is a blocking and tackling type exploration program associated with it. And from an investor's point of view, that's actually a good thing, because we can actually quantify pretty well what the return on our capital is for our exploration program. We kind of know, if we're putting this many meters in for the targets that we know about, this is not only how many ounces we're going to be delineating, but literally how many ounces we're going to be pulling from the ground and using it to process in our processing plant and turning into cash flow within an investor's time horizon. Instead of doing this loosey-goosey bullshit way of valuing exploration assets, you can actually value your exploration program in a way that comes back to cash flow, which is how any investor should be looking at the world. Sometimes it's complicated, and usually when things are complicated, people invent other metrics on ways of valuing these things. Our type of geology is not complicated in that front, is that we know that if we're going to be spending $17 million over 18 months, that $17 million is going to be paying back to us within 5 years, 5x that amount plus.
Okay. I had a bunch of questions on dividends and share buybacks. Maybe you can cover both of those. And
yeah, so the main objective of the company is to deliver its 3 objectives: getting the 500 ton per day plant up and running, use the cash flows from that to go do steps 2 and 3, the ability to delineate mineable resources that will have enough breathing room to justify expanding our plant to 1,000 tons a day, and then using it to invest in what's likely going to be about a $1.3 million a month, for as far as the eye can see, type exploration program to generate those types of returns on capital with that cash flow, right? Anything beyond that was going to be used initially for debt repayment, and then anything beyond that we're going to be allocating to shareholder returns. Well, we'll never have a war chest on our balance sheet. Now granted, I think our balance sheet got tighter than even like we like to have a tight balance sheet because it instills discipline on our operating team. I think we kind of went over the edge a little bit in what a prudent amount actually was, especially when we were having some of the operating difficulties from March to early August. So I certainly don't advocate any other mining company to be running a balance sheet that tight. And then even with us, we kind of went over the edge a little bit. With respect to dividends and buybacks, that will happen after the debt is repaid and the business is fully funded. To the extent that we actually had an executable NCIB, and we bought back 2 million shares over the course of the last year. The last shares I think we purchased was a couple months ago. The only reason why that was executed on was when we had what I thought was a a group of shareholders that just did not want to be in the stock, right? So we were having some deviations of how we were trading versus the rest of the market. So that was there really for a tactical purpose rather than a capital allocation strategy. It's been clear since after that fact, the entire market has just, forget about re-rate. It is derated in terms of valuations over the course of the last couple of months. And I haven't really seen our valuation get super out of whack with our immediate peer group in that respect. So it hasn't been active, but it was never there and intended to be a capital allocation strategy until objectives 1, 2, and 3 are met and there's excess cash on the balance sheet. Now, and this becomes a little bit of important. So the reason why Mako exists was because when this was Golden Rain, this was managed with an optimized business strategy that was to avoid raising equity capital, right? So, and it was coming from a single individual on the board. He was an investor in the space. Investors are trained in this capital intensive industry that when somebody raises capital, that's a bad thing, right? So capital raise, bad. And honestly, there's a lot of data to support kind of views like that. But, and this is a big but, we do not think about the world that way. We have a business. That business needs to be funded. It needs to be funded in a prudent fashion. The other way of doing that is back when this was Golden Rain, you can see exactly what happened. There was capital that was raised to do a resource. 2012 was really the last drilling that was done. And the directive of the board was don't raise any equity capital. And that meant don't do the work on the engineering. Don't do any exploration work. You can see the discovery hole of Las Conchitas was done with hole LC11-01. The first hole was a discovery hole that wound up hitting 61 grams over 3 meters, 30 meters from surface. It's never followed up on. Why? Because the company did not want to issue equity capital to go invest it, even though that exploration dollars were going to be generating 5, 10x return on capital. And then what happened to the company? Well, a couple of things happened to the company. After that resource came out, the stock was on fire. Everybody says, wow, this is like a flashy company. You have this pretty aggressive, not Wexford, another pretty aggressive Toronto-based hedge fund that was pushing it up to $1.20 a share over there. Everybody was super excited and great. And then you know what? Nothing happened, right? No exploration dollars, no engineering dollars. The market crapped out and it laid the path towards what Mako is today, making the original investment with us in 2014, and then going through the process of eventually merging the two companies, changing over management, and then putting us on a path where the primacy was the business. Now, for people that are looking for the returns coming to shareholders on the dividends and the share buybacks, we agree with you once the business is funded. But when you start removing capital, especially in bear markets over there, to support a share price or just to have some sort of heuristic out there, as I go, these guys are paying a yield, so this somehow must be cheaper than somebody else. You can't think about the world like that. This is a business. This is a business plan that has been executed on, but the primary objective is the business. So the one difference I would say, because I don't think the previous management and board were crazy. I just think that they were not comfortable in their positions enough to say no to shareholder requests. It's like, you know what, at the end of the day, what we're doing over here is not irrational. Like, people can say that people can say we're different. People can hate on Mako and have very logical reasons about why they don't like us. But if you actually go through our decision process on everything that we've done from the start, nothing that we've done has been irrational. Now, if there are going to be certain investors that are out there saying, "Oh, why don't you buy stock? Why doesn't your director buy stock? Why don't you do something to somehow change the stock price that I made the purchase in?" That's not the way we look at the world. We look at the world as what are our business objectives versus how we modeled it. Sometimes they're excellent. I thought our team did a fantastic job in terms of managing this through COVID, the pandemic, the hurricanes, getting it up and running more or less on time, more or less on budget. There are some times that we deviate from plan. Things happen, right? So we're not perfect. It's like we were talking about the metallurgy. Like, absolutely, in retrospect, there could have been some more reflective tests and better processes and procedures that were put in here back from early this year rather than being implemented in the summertime. And sometimes when there's deviations from plan, that changes the business that we need to adjust from. Those are the types of metrics that we're worried about, not what happens to our stock on any given day or week. This is not the type of company where you should be making those types of investment decisions about.
Okay, and then talking a bit about your strategy going forward, why are you considering a consolidation in this market? I mean, you kind of already answered that, but the second part of the question is, what do you see as the positive and negative outcomes of doing this at this point? And maybe you can talk a little bit about current valuation and depressed share price in that context.
Sure. I mean, the end of the day, the consolidation is really there for a couple of minor reasons, right? It's there to make sure that we have, once we actually go onto a larger exchange, that we have the ability to check the boxes with respect to custodial relations at brokerage, to have margin relationships with brokerage, to make it enhance the liquidity, to make sure that our stock trades somewhat better. Likewise, I mean, from a practical perspective, if you're trading at the levels we're trading at, if a tick is a half a cent, right, that's actually a big move versus a penny a tick if you're 10 times more. Obviously, there's a 5 times difference in what a tick actually means. So from a stock trading execution perspective, there's a big difference. It's going to help incrementally. It's not going to be a panacea by any stretch of the imagination. But oh my God, like think about what I said for the last 2 minutes. That is secondary. This is one of my biggest frustrations about Mako. When we actually have something big, like big, and it's not even in a positive way, that metallurgy issue that we had was a big deal. This should not be a company where I get 10 to 20 times the number of questions about a stock consolidation, which at the end of the day is nothing more than a decimal point, than I do about specific questions about metallurgy. And I'm actually really appreciative of that first question that we have that was actually going into the details about what we could have done differently about it. These are the things we care about. There are going to be incremental things that we need to do as the company grows. But guys, it is a business at the end of the day. When this company was managed as a stock, it failed. The company needs to be managed as a business.
You answered the question correctly. I asked the question incorrectly. I actually thought that they were asking about your strategy of consolidation.
That's a completely, so apologize for yelling at the anonymous person who didn't ask the question.
You answered their question. I read it wrong. But I'm interested in my question.
That's a bigger, more salient question that actually has everything to do with the business strategy. Look, the end of the day is, and I said this from 2019, said if we were able to execute on everything that we wanted to do, you could see it on our plant over here, is that there is just not space to go and if this ever would move, there's not space to be building a larger plant than doubling that in size. We have the footprint there for 1,000 tons a day. Everybody saw just how difficult it is to be drilling a lot of meters. It's probably going to be pushing over 200,000 meters that we drill by the time that this thing winds up getting into 1,000 ton a day scenario. So in order for us to, let's say we make a discovery to the north over at Segovia, we're never going to get ahead of ourselves to justify having a completely separate plant to be mining this at 2,000 tons a day. 1,000 tons a day, that is the natural conclusion. Maybe it could be like incremental improvements over there just for efficiencies. Let's say in and around 1,000 tons a day is kind of where this thing caps out. You can see how we selectively mine it and kind of how the grades that are coming through the plant and what our normal recoveries are going to look like at the end of the day. And 1,000 tons a day, everything kind of holds together, equates to about a 75 to 80,000 ounce a year producer. Now, granted, it's a 75 to 80,000 ounce a year producer that's generating at these gold prices, even probably somewhere in the neighborhood of about 50 or 60 million bucks a year, maybe even more than that. And then the gold prices that we had 3 months ago would probably be more like 70 or 80 million dollars. So it's extremely profitable, but at the end of the day, it's still too small of a company. So the overall objective was to get Mako from a position of having a good profitable asset and getting ourselves into a situation where we could be part of external opportunities that come along the pike. Full stop. We will not do anything that's dilutive. If our share price goes down to a certain extent that we can't do anything that's accretive, do you know what we do? We don't do anything. Like, it's perfect. Like, doing nothing is like, there's a lot of people that actually struggle with doing nothing. We have no issues doing nothing. On Saturday morning, I can be on a couch for 5 hours and not worry about anything. My wife can say I'm lazy. It's okay. I don't mind doing nothing. We only do accretive transactions if the opportunities arise. It just so happens that this is a particularly rough bear market, that even though our stock has had a pretty fantastic drawdown in and of itself, the people that make sense for us, and there's a very, very small subset of companies that do make sense for us, really have not changed from a relative valuation to where we are. So some of the conversations that have started really going back since 2019, and sometimes even before then, have continued. And for us, if we're trading at X and they're trading at Y, and then all of a sudden we're at a half X and they're at a half Y, I really don't, it doesn't, in fact, if anything, it makes me more encouraged about doing things, because the psychology of the market kind of improves for the transactability of these things. Like, Mako doesn't have what I consider to be like a functional currency. It's not like we can go and say our stock is like cash. Let me go and buy you for the number of millions of dollars you think your asset and I think your asset is worth. It's not how our stock. At some point, I would love it for it to be like that. If we were a Barrick or a Newmont or a Kinross, they can make those decisions any day of the week. They can go to a junior mining company. I think you're worth $500 million. I'll give you $500 million of my stock. They said, sure, I can value your stock as a cash quote. People don't do that with Mako. So we have to have like a small subset of companies that make sense, geologically, socially, like people that want to work with us. So all of those things are good attributes to have, and it kind of like steals our focus on the M&A side of things. And the only thing that I can say, and it's been kind of surprising to people when I've said this publicly, the only thing I can say is that nothing has really changed from relative valuations, at least for the people that I'm talking to. The only thing that's changed, I think, is psychologically, people are more apt to want to do something. So I've been more encouraged about M&A than I have been in years, even though it's always been part of Mako's strategy.
And then I had another question, which was just about acquiring adjacent land, which I guess is also falls in the M&A bucket. Is it difficult to acquire adjacent land in order to expand your resource in the future? Is that something that you're looking at currently?
We have under application that the chunk of land that you see on the right, or the vast majority of the chunk of land that you see on the right, that's the last remaining parcel that is not under government control or ownership on the concessions. So goes back to kind of like the balance sheet dance. It's like that is in an area where it's not even like 5th or 6th priority to us. So the government has not granted us the concession yet on it, but at the same time, we're not like begging for it, because then we'd have to pay additional taxes and do some work there for that matter. So even though I think that was put under application, I think almost not quite 2 years ago, about maybe 1.75 years ago. If it comes now, great. If it comes in 2 years, frankly, that I've got bigger fish to fry, if you will. The rest of the surrounding ground is under government control. We've had sporadic conversations with them going back a decade on it. You could see, geologically speaking, that where the ore body kind of dips to. So that's the left of your screen over here is to the northwest. So you can see where the northwest is pointing. So certainly on that grounds, if there's something transactable with the government, then great. We would love to do something.
Can you talk a little bit about relations with the government, with the local community, with the indigenous populations, and how important it is for your strategy to start diversifying outside of Nicaragua? Sorry, that's about
Sure.
4 questions tied into one, but I'm trying to get through all of them before the 90 minutes.
Yeah, sure. So the first and foremost, the biggest risk of any mining company, and by extension by a mining investor and investing in a mining company, is jurisdiction, because we can't move the ore body, right? So it's like it's there where it is. We're in Nicaragua. It's not like we can move to Honduras even if we wanted to. So everybody should bear that in mind. The political situation in Nicaragua is controversial in nature for very valid reasons. So I don't begrudge any investor that's not comfortable investing in Nicaragua because of who runs the country, the politics in general, geopolitics in general, make it perfectly rational to make those decisions. The only thing that we could say operationally is that we've operated in a lot of jurisdictions across our team. Nicaragua has been, from soup to nuts, so from the exploration side to bring it into production, and what that entails and what that means has been, I don't want to say the easiest, but it has been the cleanest path of doing that from A to Z over there. And a lot has to do with the fact that the bureaucratic and administrative class in Nicaragua are transparent, clean. They want mining there. So the relationships that we have are good at the government and bureaucratic level. I gave this anecdote over at Beaver Creek, is that one of the reasons why we haven't applied, there's a couple of reasons why we haven't applied for the Las Conchitas mining permit yet. One is on the surface rights that I was talking about. The other one is that we were about to, I mean, we're going to run out of waste dump capacity over at San Albino by Q3 next year. So a year and a half before that happened, we tried to get a permit accelerated over at the north end of Las Conchitas for a 23 million ton waste dump. And then probably in retrospect, we just didn't have enough geotechnical information. And the government basically said, look, you don't have enough geotechnical information to support a waste dump that size. We'll give you a permit on 8 million tons, do the work, come back to us. And then if it's good, we'll give you the permit on the balance. There's not a single jurisdiction in the universe that would approach permitting that way. It's not like it was a blank check or a rubber stamp. They basically said that there was certain data that they wanted to see before they were comfortable granting a permit. But at the same time, they want this mine there. So they're going to do everything in their power prudently and for the good of the people of Nicaragua and the communities in general, to make sure that everything is safe, sound, environmentally secure, and everything associated with it. To sustain these operations for a long time. It's a pleasure to deal with practical administrative organizations like that. And again, it's because it's transparent and because they want you there. Unlike, I would say, a heck of a lot of other jurisdictions, inclusive of people that would rank much higher on a geopolitical profile risk from a mining investing standpoint than Nicaragua. And the only thing I said, our operations in Nicaragua have been great. With respect to the community, it's been near universal support across everybody. And we actually live in a diverse area. So some people are evangelical, some people are Catholic, some people are Sandinista, some people are Reforma. I would say 10 years ago, the towns didn't talk to each other. There's kind of like these interesting feuds that go on with people, but everybody works for Mako. Everybody kind of likes being there. We treat people with respect. They're part of the community, right? So whether they're working for Mako or artisanal miners or people just working in town. Everybody kind of knows each other, and it sounds kind of corny, but it's like a family. It really is. So everybody's kind of proud that that the asset is up and running. This is a politically important mine just because of the history behind it. For those that don't know, this was the birthplace of the 1926 and 27 Civil War in Nicaragua. Augusto Sandino was a general manager over at the plant back in 1926. So the namesake of the Sandinistas comes from our mine. So it's important politically that that this is going up, and everybody is proud that for the first time in 90 years, it's I guess now it's 95 years, it's up and running.
It is an interesting area for sure. Let me just see, there's a few more questions. I'm trying to find a natural sort of path to them. Actually, maybe we can talk a little bit about the weather. You're in rainy season. There's been a couple storms going through the eastern part of North America recently. Have you guys had any weather issues yet? How's the rainy season been so far?
Normal, I would say. If you saw this yesterday, it would be wetter. We had a pretty big rainstorm yesterday. You can see it's pretty dry today. 2020 was a weird experience. Like prior to that, Nicaragua has only been hit by 7 category 3+ hurricanes in 100 years prior to that, and then we got 2 in a 2-week span. They actually ran out of English letters, so we got hit by Hurricane Eta and Hurricane Iota, and actually both of them hit after rainy season was over. So both of those hit in early
I think it was late October,
late October, early November, exactly. So like our rainy season is basically is over in a couple weeks. Rain's picked up a little bit. I mean, it's kind of an interesting ore body. You can see on the screen over here. On occasion, you have some pit stability stuff, but it's like very slow moving. So we mine it prudently. Sometimes when it's wet, we have to monitor it, but we haven't seen anything that would interfere kind of with operations in the intermediate and long term. So water is always a challenge. I think everything kind of runs slower in rainy season. So I think a lot of the stuff that we've done metallurgically, it was kind of necessary to slow things down a little bit. But I think even with rainy season, we were like slowing things down. So I think we're averaging maybe like high 400s for the quarter as opposed to 500. So stuff like that you need to be cognizant of during rainy season. But Q4 we'll be back into dry season.
Okay. And talking a bit more about the balance sheet, when you talk about improving the balance sheet, does that mean a secondary offering or using the cash flow to reduce debt and build cash?
Well, with respect to the debt side of things, right? So really everything that we've had, the exception of the $400,000 in share repurchases over there, was for debt repayment. So, and like we're not magicians over here. So this is the first 12 months of operations. $32 million of pre-tax mine operating cash flow that led to $9.8 million of debt repayment. In the now 15.5 months of operations, that's just under $40 million of pre-tax mine cash flow, $12.4 million of debt repayment. That $8 million of exploration that we spent, that's now up to about $12 million itself. So it's $24 million of capital that went to debt repayment and exploration. You can add that $400,000 in share repurchases as well. And that led to our balance sheet remaining with the $6.8 million of debt that's there. But as I said in March, our expectation that would have been zero by Friday of this week. So obviously that didn't happen. We'd have loved to have had the cash flow be used to go and repay that level of debt. So what happened after we had the metallurgical issues for Q2. So that was when we were having the 74.5% recovery. And that was effectively at 1860 gold, right? So what we were doing, you could see exactly what we had for the gold price. Theoretically. I'm not sure if it actually shows it over here. I think we were at 1860 for the quarter, roughly, if memory serves me correct. So at 74.5% recovery, at 1860 gold, $7.5 million came from the mine pre-tax, and that was sufficient to repay $1.7 million of debt capital and $2.7 million of exploration spend. That exploration spend is now just under $4 million. So that's 1.3. That's basically increased for growth exploration. And depending on how you want to leave the balance sheet, 1.3 versus 1.7 at 1860. We're now at 1650. I mean, that's $200 an ounce difference. So the mine itself is still very profitable, but there's a lot of growth objectives that you need to have for the company going forward, inclusive of CapEx items that we need to have for Las Conchitas. Now we're prudent. Obviously, that's the reason why we're drilling the 7 rigs kind of in the area by the mines. We're not doing regional drilling, even though I would say a more promotional mining company would be doing something like that to have those splashy results. But we have to be cognizant in terms of what the business is capable of generating in the 500 ton per day scenario. It's actually one of the reasons why we want to get to 1,000 tons a day, because a lot of operational synergies that even at these gold prices, those numbers are going to be more than doubling from here. But we're not magicians, right? So the business is, we've been literally as transparent as we possibly can about where the business is. But the business is the priority. And to do that, we'll do things in a prudent fashion. It can take like a whole host of different directions. I would say the one thing that Mako can't have right now, just because you've seen some of our forget about like our competitors, some bigger and more liquid names that have tried to do like bought deal financings and broker led financings. It's just, the market is just not there. That being said, we do have things in our toolkit where we don't have to participate in dysfunctional markets. But when something arises, the only thing I can talk about right now is my thought process. And when something arises and there's something to discuss publicly, I'll be glad to do that. The only thing that I'll say is that we view the business as the number 1, number 2, number 3 most important things over there. And we make sure that we do things that are prudent, kind of in the confines of what Mako is capable of doing in its first stage of operation in this new gold price environment.
Makes sense. I had a question on EBITDA. Is it unrealistic to expect 6 cents a share of EBITDA in 2023?
So you're asking me to convert I would say, and you can see kind of in how the numbers arise, because we report. By the way, I think adjusted EBITDA is the right metric to use, because the only real adjustment that we do is the exploration spend, right? So, I don't want to like play around with earnings numbers over here, but that is the business objective. The business objective is to take all of the dollars coming from our mine and then funding it into exploration. And because all of our exploration is focused on regional stuff, it gets expensed. So that's a deduction from income and by extension from EBITDA. I think pre-tax mine operating cash flow is 95 to 105% of adjusted EBITDA. I think these are reasonable numbers to look for. So what happens at 1860? At 1860, at 74.5% recovery, 7.5 is the number. Multiplied by 4, that's 32. That's what is that? It's not quite 6 cents. It's probably like 5 and change in terms of what the adjusted EBITDA is. What gold price do you want to use? You want to use 1860? hopefully we get back to that. You want to use today's gold price? Well, you're going to have to deduct $200 an ounce off of what effectively was a 36,000 ounce run rate. So that's $7 million off of that number. Now, likewise, we have some improvements metallurgically about where we slow down the system somewhat. So it's kind of like in that kind of range. But the reason why I actually really like these charts is because it shows exactly what the business does, right? It shows you what we started with, shows you what the mine generated, what it was spent on, what our objectives are, where it's going, and how it gets funded, and what we end with over time. So you don't have to do any like fancy modeling to see what the business is. You start with the gold price and you kind of see how these waterfalls behave. But I think that mine operating cash flow is a pretty decent proxy for adjusted EBITDA. But I'll say again, we're not magicians. Like the business operates as the business does. You have to operate in the environment that you're in. I think it's fair to say that Q3 was a bit of scrambling mode, right? I mean, we had a pretty big whack in terms of that metallurgy. So there's a lot of test work that we needed to do. So I don't think our operations are running as efficiently as they can. So I think there's probably some movement that we can do and reduce on the cost side going forward. So I think there's probably a little bit of room for improvement, but it's not like there's been much wasted expense. It's not how we operate businesses. So efficiency, absolutely, because it takes time to make sure that everything gets fine-tuned. But like from a wasteful spending perspective, there really isn't much fat at the organization.
And can you talk about what your cash costs will look like when you get to 1,000 tons per day? The actual question is, what do you project the all-in cost to be, barring unexpected conditions, i.e. weather, assuming all else being equal, labor costs, etc.?
Sure. We saw a pretty reasonable size step function in costs from Q4 to Q1, like real costs, and then there were like weird modeling stuff that kind of flew through everything. So I think we went from just below $900 an ounce to the 1121 that you see, I think, from Q4 to Q2. We really haven't seen much in the way of a step function in terms of our attributable costs. I think our processing costs have been elevated because we were trying to figure out how to manage the detox and kind of our processing. That will be a Q3 noise event now that everything is kind of stabilized. That will start heading back down to numbers like this. And then I would caution people on comparing these. So you have certain situations where they're like obvious, let's say, conflation of what AISC means. Like sometimes it's obvious in that you have these projects out there, and the projects over there, they get this nice consultant, and they say, all right, we're going to generate the all-in sustaining costs of $1,100 an ounce, and we're going to be producing more gold than you, Mako, so therefore we're cheaper. And then the response to that is, leaving aside any of the input parameters that go into that, it's a project, right? That doesn't involve anything to do with the actual company, right? Our 1121 over here is not a project level AISC. That's everything that it takes to run Mako, inclusive of legal and accounting and listing fees and in terms of the business. So I think people look at these things as a frame and as a number, and trying to see what company is cheaper than other, when they're obvious things, and it messes with even my mind sometimes. And then you actually have producers that just ignore certain things, even though the World Gold Council kind of like lists everything that you should include and should not include in AISC. And then there are people that just completely ignore some of the things that they do just to make their numbers look better. So I tell people is, like, do you know the entire reason why AISC was created? The entire reason why AISC was created is because investors basically said, I don't understand any of the numbers that the industry reports. like it doesn't make it. So I've stopped paying attention to it. So either you have investors there that basically just stopped investing in gold mining, or you had other investors that needed to invest in gold mining that just didn't pay attention to the earnings and cash cost numbers that the mines were producing. The genesis of that number was there because the industry was trying to conflate what their real costs actually were. And to me as an investor, I never liked any of these numbers. And then when I went through that like modeling change that we did with PwC, it's like, oh, why do people, what I care about is this. I care about where the cash is going and what it's being used for. So we'll put out an AISC just because a lot of investors ask for it. But I used to be an investor in the space. I don't like those numbers. By the way, we totally plagiarized this chart from an Australian producer. I think the Aussies take liberties with certain stuff, but I actually think they're very good at actually showing where the cash is going. So I think more Canadians should put out something along these lines as well. It shows you exactly what the business is capable of doing and what it's delivering.
Okay, well, that's it for questions, Akiba. Is there anything you wanted to talk about today that we haven't covered?
Yeah, look, I think bear markets play with people's minds quite a bit. That's not like it's not like a kumbaya statement, like everybody should just hang in there, guys. What I do mean is that I'll tell you even something over at the conferences. I was also surprised. I think some people have commented on social media that they were surprised. I was definitely surprised that we did not see any M&A happen. Forget about Mako, just like the industry in general. Because when you think about what's going on, it's just logically, it's that you have lower gold price, you have investors that don't want to participate in capital raises in a capital intensive business. So when you have an inflationary environment, you have costs going up, revenues going down, and your cost of capital is going up as well. The logical response to that is consolidation, because that's one of the clearest ways of being able to reduce your cost structure. But people don't act, and the reason why they don't act is because the incentives of moving forward with something are not there. Is that like an acquiring party on a large cap side will get eviscerated if they announced a deal, and a lot of these deals aren't really clearly accretive on the day one based on public information until companies have had a chance to kind of grow into what they acquired, and people are very fearful about losing their jobs and fearful about making a mistake and fearful about investors complaining and stuff like that. We're certainly cognizant about the public markets and the environment and the ecosystem that we operate in, but one of the things that we do very, very well, and that's with me and with Wexford, is to make rational decisions irrespective of the environment that you're operating, right? So I would say it's like we're not fearful. Things change. Things have certainly revalued. I would say you can't really look at an environment like this that if you bought whether it's our stock or somebody else's stock at X and now it's trading at half X, it's somehow half cheaper. It's not necessarily the case. I mean, there's a lot of operating margin that has come away with the decline in gold price, costs going up across the board. There's obviously a change in cost of capital as well that need to be cognizant of. So I think with that is that it's always good to take a deep breath, evaluate what you have, why you're into a position, about whether it makes sense, whether there's something that you don't think is being valued by the market or otherwise, and then understand that the management of this company, while we're aware, I mean, we breathe the same air as you guys do. We do run this business though, where every day is a rational decision. That's not to say that we don't make mistakes constantly, but our decisions are rational and not made out of fear.
Okay. I think that's a good place to end it. If anyone has any additional questions, feel free to reach out. If anyone wants to book a call one-on-one, also feel free to reach out. And thanks so much for taking the time, Akiba, to give us an update.
All right, as always, Deb.